Hello everyone, I'm Dr. Pramesh. Would like to discuss something about credit risk management in banking sector. As being an academician, my approach of credit risk management in banking sector might be differ with the banker. First of all, I would like to start with the definitions of credit risks. Credit risk is the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligation. Try to understand, it is a major risk or problem in the bank, and this may lead to have more non-performing assets in the bank. Types of credit risks. Types of credit risk is divided into credit default risks, concentration risks, country risks. Let's first start with the credit default risks. Such risks of loss arising from a debtor being unlikely to pay its obligations in time, it is known as the credit default risks. So what are the possible chances to come the credit default risks in the bank? The reason might be mismatch in assets and liabilities of the company, and the company are in not positions to generate more revenue in the current time, but they are expecting to generate more cash flow in the future time. And third possible chances is that possibility of increased expenses. So these three are the major reason of having the credit default risks. Now I will move to concentration risks. Such type of risk arises when a bank or financial institutions has lent to a single borrower, a group of borrowers, or borrower engaged in a dependent on one industry, say example tourism sector. If the bank provide the loan to the one sector only, those who are engaged in the one sector, say example tourism sector, so for that particular company whatever they earn, that comes from one sector only. If that sector does not perform well in that particular year, what will happen? There is a chance of risks in the company, and that risks directly affect to the banks, because bank has provided the loan to the that particular company to do the business in some tourism sector. So such type of risks may hamper the entire operations of the bank. Now let's go to country risks. This type of risk is prominently associated with the country macroeconomic performance and its political stability. Such type of risks may come because of financial market risks, because of political risks, and one the economic risks. You can take example of the demonetization. That brings the risks to the bank. That risk is known as the country risks. Now try to understand non-performing assets. In simple term, we can say when an asset ceases to generate income for the bank, that is known as the non-performing assets. This is the major problem in the banks. As per Reserve Bank of India provisional data on global operations as on 31st March 2019, the aggregate amount of gross non-performing assets of public sector bank and scheduled commercial banks were rupees 8,06,412 crore and rupees 9,49,279 crore respectively. Although I have given the reference here. Now here I will make you the difference between the selling a financial product and selling a other product in the market. There is one big difference between selling a financial product and selling a other product in the market. So if you sell the financial product, you will expect some kind of return, that return in the form of interest or whatever else may be there. And but when you sell other product, take example of So you'll not expect anything. Okay, that is the final one. So the sale of money is not final. You expect it back with interest. Now let's discuss about the instruments of credit risk management. Credit risk management helps the banks in mitigating or reducing the adverse impacts of credit risks. There are various techniques which are briefly enumerated as below. Credit approving authority. Each bank should have a carefully formulated scheme of delegations of power. So here I have highlighted here flow chart of approval process. Marketing or sales manager handle the credit proposal from the customer, and the marketing and sales manager, they will just evaluate the proposal. Then after, they will just send to the head of branch to accept or to decline the proposal. So they have the discretionary power. Beyond their capacity, they will just recommend it to head office, and head office will forward it to credit officer for further analysis, and the credit officer just forward it to the decision of appropriate approval authority. After that, the decision is sent to the branch credit administration department for documentation and disbursement. So this is the process of credit. This process of the loan, that how to take the loan. So flow chart of approval process is given here. Now try to understand. This is one of the efficient way to handle the credit risk in the banks. In this regard, credit approving authority, I will just highlight the few sentence as the sentence that is given by our former Governor in the Bank of India, Raghuram G. Rajan. Local financial institutions with local control and staffed by knowledgeable local people could be more effective at providing financial services to the excluded. In this regard, I feel that banks staffed by knowledgeable local people will work more efficiently and effectively in the local banks because they can understand the credit worthiness of the individual and the company. So this is also one of the way to control the credit risks in the bank. Now I will move to the second technique, that is known as prudential limit. Prudential limits is the guidelines and general norms issued by the regulating bank, or we can say the central bank in our country, Reserve Bank of India. In order to limit the magnitude of credit risks, prudential limit should be laid down various aspects of credit. So first one is stipulate benchmark for various ratio. So as been providing the loan to the customer or the to the company, first of all, the bank have to understand that the position of the debt equity ratio and the position of the profitability ratio and the positions of the other ratio, that may be the current ratio, liquid ratio, absolute liquidity ratio. So on the basis of that indicators, bank can avoid the credit risks. So second one is single group borrower limits. As many bank has imposed that for the home loan, maybe for the maximum limit is 10 crore. Some banks has given the limitation of 3 crore. So this is also one technique to avoid the credit risk in the bank. Third one is the prudential ratio. This is the guidelines and general norms issued by the regulating bank, that is Reserve Bank of India of the country. So they may be, they may give in the form of capital adequacy ratio, or maybe in the form of the CRR or SLR, cash reserve ratio, and statutory liquidity ratio. Third one, just try to understand risk rating. Banks should have a comprehensive risk rating system that helps for taking credit decision in a consistent manner. So I have highlighted here risk level and the comfort zone. Those the individual who belongs to 86 to 89 score, there is lower risk. So the banks can provide the loan without any hesitations to the company. And if the company belongs to the score of 45 to 49, this is the acceptable risk. So there is some kind of risks that are associated here. So banks will be in dilemma to provide the loan to the company. So this is also one way or techniques to avoid the credit risks in the banks. Fourth one is that risk pricing. Risk return pricing is a fundamental policy of risk management. In a risk return setting, borrowers with weak financial positions should be priced high because it plays in the high credit risk zone. So those the company who belongs to the high risk, the price should be charged high. And here the risk-based pricing means that the credit market refers to the offering of different like kind of interest rate. So for those the firm who belongs to the high risk zone, as the bank have to charge the high interest, and those the company belongs to the risk zone, they will charge the least interest. That is the one way of avoiding the credit risk in the banks. Beside above these cases, the value of collateral market forces, perceived value of account, future business potential, and strategic reasons may also play important role in risk pricing techniques to avoid the credit risks in the banks. Fifth one is portfolio management. The existing framework of tracking the non-performing loans around the balance sheet date does not signal the quality of entire loan book. So that's why it is given that prevention is better than cure. So you can take the recent example of Yes Bank crisis. Many authority has claimed that Yes Bank has underreported non-performing assets during the financial year 2018-19. That may or might be one reasons of the Yes Bank crisis in India. So in order to control such type of risks, banks should evolve proper system for identifications of credit weakness well in advance. Most of the international banks have adopted various portfolio management techniques for gauging asset quality. Now last one is loan review mechanism. Loan review mechanism is an effective tool for constantly evaluating the quality of loan book and to bring about qualitative improvement in credit administration. So loan review mechanism can be done in different aspects. Like I already told you that each credit approving authority, each bank should go for cross-check for credit approving authority. And another one is the prudential norms. Each bank should go for review of the guidelines and general norms issued by the regulating bank, that Reserve Bank of India. That norms has been followed by the banks or not. That's also one technique for the loan review mechanism. And third one is the review of the risk rating and the risk pricing. Last one is the portfolio management. Here portfolio management means that planning, organizing, coordinating, staffing and controlling of different banking activities in order to avoid non-performing assets in the banks. So this is the last techniques in order to control the credit risk in the banks. Although there are various techniques which I have to discuss here in this slide. Thank you so much.